Today we are going to discuss about LKS 1, that is presentation of financial statements. And today's session is about structure and content of general purpose financial statement. This is the second part of this session. Right. Now we'll discuss about the structure and content now of financial statement. Right. Identification of the financial statement. An entity shall clearly identify each financial statement and those notes. So as we discussed in the previous session, there are 5 different types of statements. Uh, Statement of financial position, statement of comprehensive income, statement of cash flow, statement of changes in equity, and notes, right? So each and every statements have its unique characteristics and components. So identification of financial statement is very important. And in addition, an entity shall display the following information prominently and repeat it when necessary for the information presented to be understandable. Right. Right. Number 1A, the name of the reporting entity or other means of identification and any change in that information from the end of the preceding reporting period. So identification. So identification means simply uh, when you take a financial statement, you should understand these financial statements of which organization, of which entity, right? And what's the title of the organization, title of the statement, whether it's financial performance or financial position or case flow statement, and which period, whether it's for 2018-19 or 1920 or 1st of January to December 31st December, or from 1st of March to sorry, 1st of April to 31st March. So the kind of information we need to correctly identify. So how we can identify easily? So by looking at the title. By looking at the title of the financial statement, it is easy to identify. And so for the identification, first we find, first we have to uh, quote the name of the reporting entity, XYZ company, Abhenayaka Enterprises, ABC Limited. So that kind of information we need. The name of the reporting entity or other means of identification. If there are any other ways to identify the reporting entity, that way also acceptable. The name of the reporting entity or other means of identification, any changes in that information from the end of preceding reporting period. So if there are any changes on its name, reporting entity's name. So last year the name of the entity was XYZ Limited. Now during the current period, they have changed XYZ Limited into ABC Limited. This time they have to clearly mention our name has been changed from XYZ Limited to ABC Limited. It's very helpful to take a clear decision. And first, name of the reporting entity. Second, whether the financial statement are of an individual entity or group of entities. When you look at the financial statement in the annual report, you can find 2 columns. Uh, First column is for the separate entity. The second column for the groups, holding company and subsidiary company. Right? If it is a single entity, you can find only the individual entities report statements. And if we, in case of group of companies, holding company or subsidiary, that time we can find two columns. In addition to individual performance in, and also report the group performance. So whether the financial statement are of an individual entity or group of entities. It's especially for the group of companies, holding company, subsidiary, joint venture, associate, that sort of stuff. Uh, and the third, the date of end of reporting period, 31st March or 31st December, or the period covered by set of financial statements or notes. Sometimes organization entities report the financial statement not for 12 months. Sometimes they issue intermediate, right, for 6 months, quarterly report, semi-annual report. So it should clearly mention the period covered. And the presentation of the currency as defined in LKS 21, that's foreign currency translations. And there are companies, it has many branches worldwide. Say Samsung is a Korean company. It has subsidiaries in many part of the world. A Dialog, so a holding company is from Malaysia, and they have a business in Sri Lanka. So when they report financial statement in Malaysia, they have to decide whether they are going to report in US dollar or in Malaysian currency or Sri Lankan currency. In case of Eleven House, it's a part of John Kills, and John Kills is a multinational company. So when they report, they have to mention whether it is in terms of rupees, whether in terms of US dollar or other currency units. And Nestle, so Singer, so it has multinational companies. When they report, and the report uh, they have to disclose very clearly which currency report the presentation has done on which currency. The level of rounding used in presenting amount in the financial statement. Some companies less three zeros, it's been thousands, right? For 20,000, they put only 20, and they will hide three zeros. Some companies will hide six zeros, it's been millions, in millions. Some companies hide nine zeros, billion. Some companies will hide 12 zeros. It's based on the nature of the business and the country of the origin. If government prints millions of rupees, not a million, then you know the value of the currency. So that time they may hide three zeros, nine zeros, uh, right, to sometime 12 zeros. So it's depend on the economy. All such information should disclose very clearly. These informations will help them to identify the financial statement correctly. Then structure and content. And then now we'll discuss about statement of financial position. In other words, we can say balance sheet. When we talk about in the viewpoint of LKS as an accountant's point of view, we have to say a financial position, not balance sheet, right? And income statement, not profit loss account. So in this is the way, is the way of identifying the statement, calling the naming the final statements. So we have to talk in line with LKS, Lanka Accounting Standard. The Lanka Accounting Standard not mention, not call the statement as a balance sheet. It called as financial position, statement of financial position. As a minimum, the statement of financial position shall include line items that present the following items amounts, right? Line items, that is important. Line items mean, no, they aggregate the total. When you look at the cash, you can find only cash. Inventories, we can find inventory in a single row, single line, right? In that inventories, there are so many variety of items. material X, material Y, material Z, material P, right? Iron material, right? So there are so many different types of materials included in the inventories. But when you look at the financial position, you can find only inventories, a single item, so aggregated. The inventory include aggregated all the different variety of inventories in a single line. So that's a line. As minimum, at least, the statement of financial position shall include line items that present the following items amount. So whatever the entity's financial statement, financial position, you may find a property, plant, equipment at the top of the financial position. You can find property, plant, equipment, investment property, intangible assets, financial assets, excluding amounts on in EHI. That is investment accounted for using the equity method, biological assets, inventories, trade and other receivables, cash and cash equivalents, the total of classified, the total of asset classified as held for sale, an asset included in disposal groups classified as held for sale in accordance with SLFRS, SLFRS 5, non-current assets held for sale and discontinued operations. In addition to that, trade and other payables, when you look at here, up to this point, from property, plant, equipment, up to biological assets, this is it will be listed under non-current assets. And from inventories, G, H, I, J, it's coming under non-current current assets. And trades and other payables, provisions, financial liabilities, and assets for current tax. So it's explained in detail in deferred tax LKS 12 income taxes. So we have special unit on LKS 12 income taxes. So we will discuss in deep manner about income taxes, very important standard. Deferred tax liabilities and deferred tax assets. Liabilities included in disposal groups classified as held for sale in accordance with SLFRS 5. Non-controlling interest, sometimes we call as minority interest. Non-controlling interest presented within entity, and issued capital and reserves attributable to owners of the parent. So these are coming under equity. So when you get the financial position, you may find non-current assets, current assets, current liabilities, non-long-term liabilities, and equities. All these line of items you may find. Line items, which mean a group, right? It's group. Line items are included when the size, nature, or function of an item or aggregation of similar item is such that separate presentation is relevant to an understanding of entity's financial position. So why do they grouped as line items? To better represent the financial information to the users. So the line of items is categorized. The items in the entities are categorized into line items based on their size, the nature, or the function of the items. An entity makes the judgment about whether to present additional items separately on the basis of an assessment. Sometimes even we find inventory, it's a single line of item. Sometimes it may require, they wanted to show the inventories in much detail. right, in much detailed manner, because the management uh, perceive that showing the inventories in separate line of items will give more meaningful information. In that circumstances, they can do so, right? So it's based on their judgment. Entity makes the judgment about whether to present additional items separately on the basis of the assessment of the nature and liquidity of assets, nature and liquidity of assets, the function of assets within the entity, and the amount, the nature, and timing of liabilities. Based on these three circumstances, they can make judgments. The use of measurement basis, use of different measurement basis. So uh, some assets are measured based on their historical value, historical cost. Some assets are valued on market fair value. Some other assets are revalued, right, time to time. So there are different methods. So if they measure in different, some class of items are measured in historical value, historical cost. Some of the assets are measured based on their fair market value. So in that circumstances, they have to disclose the item separately. The use of different measurement bases for the different class of asset suggests that their nature or function differs, and therefore that an entity present them as separate line items. Separate line item. For example, different classes of property, plant, equipment can be carried at cost or at revalued amount in accordance with LK 16. And some of the items are valued in historical cost, so that in that groups will be disclosed separately. Some items are uh, valued in fair value or market value, then that item should be disclosed separately. Now we'll move to the current assets. Current assets. An entity shall classify an asset as current. As current. So to classify an item of asset as or under the current assets, it meets some conditions. First, it expects to realize the asset or intends to sell or consume it in its normal operating cycle. Normal operating cycle. So, for example, an entity purchase material. Now it's become inventory. That material will be used to make the final output. It will enters, the material will enters into the transformation process, and it's become a final good, final item, a final finished goods. Then it will go to the showroom until it sells, until delivery to the customers. Or there are some materials will be used for the normal consumption. For example, uh, entities purchase papers, A4 sheets, not for making sales, for their administrative purpose, day-to-day operations purpose. It consumes electricity. They consumes. Okay? So it expect to realize the assets. Some they wanted to sell, right, or intend to sell or consume it in its normal operating cycle. Normal operating cycle is day-to-day operations. It holds the asset primarily for the purpose of trading, buy inventory and sell inventory. So, for example, a rice shop, right? Rice shop. They purchase rice and they resell the rice to the customers. The shop owner purchase rice from rice mill, and they will sell to customers. It's what? It hold the asset primarily for the purpose of trading, buy and sell, trading. It expect to realize the asset within 12 months after reporting period. So an entity purchase some type of asset, but the purpose of purchasing such asset is to resell. For example, land. An entity purchase land in a particular area for the purpose of resale within 12 months. So in that circumstances, it will treat it as current assets, not under the non-current liability, because the purpose of the purchase of land is not for the purpose of use. Rather, the purpose is selling the land to make profit. The asset in cash or cash equivalent as defined in LK 7, that is cash flow statement, unless the asset is restricted from being exchanged or used to settle a liability for at least 12 months after reporting period. So cash or cash equivalent. When we talk about cash equivalent, checks or some negotiable instrument. In the negotiable instrument, there are some conditions they unable to exchange, or they unable to realize as cash within 12 months. So they may put the date 18 months, 18 months the date. So it's mean they are unable to convert into cash within 12 months. So there are some restrictions. So to categorize as current assets, it should meet the following criteria. First one, in its normal operating cycle and the purpose of trading, and expect to realize the asset within 12 months, and at least the cash and cash equivalent, right? An entity shall classify all other assets as non-current. If any assets not satisfy this criteria, all such items will listed under the non-current assets. The standard uses the term non-current to include tangible, intangible, and financial assets of long-term nature. It does not prohibit the use of alternative description as long as the meaning is clear. If the management decides to put a different name rather than non-current assets or intangible or financial assets, they wanted to give a special name for that items. In such case, if it gives more clear understanding, clear meaning to the users, then the standard allows to do so. So very simple. By using this diagram, we can understanding the things we have discussed here, right? So this information, this slide is translated into this flow chart. Based on the flow chart, you can decide whether a particular asset belongs to non-current assets or current assets. You can decide easily whether the current assets will be classified under the current assets or non-current assets. So these are the 5 criteria. First, asset is a cash or cash equivalent. Definitely, if it is answer is yes, it will goes to current assets. No, the asset is not cash or cash equivalent. The answer is no. Then we have to check the second criteria. It expect to realize the asset within 12 months after the reporting period. After the reporting period, the entity has an intention, expect to realize asset. The answer is yes, then it belongs to current assets. But if the answer is no, then they have to go to the third criteria. it expect to realize the asset or intend to sell or consume it in its normal operating cycle. Think about inventories, materials. It may be consumed during the course of business. They will use the material to make finished goods. It's a normal operating business or trading, right? So if the answer is yes, it will be categorized as current assets. If the answer is no, then goes to the final criteria. It is held primarily for the purpose of trading. Definitely will go to the current assets. And if the answer is no, then it will be goes to the current assets. So how many criteria? 1, 2, 3, 4. There are 4 criteria here. 1, 2, 3, 4. Right? Then based on this flow chart, you can easily decide whether the item belongs to the current assets or non-current assets. Operating cycle, you may study it under the financial management. Operating cycle, gross operating cycle, net operating cycle in a clear manner, right? The operating cycle of an entity is the time between the acquisition of assets for processing and the realization in cash or cash equivalent. Normally, operating cycle start from purchase of inventories, and it will keep the inventories will be keep in the warehouse, and the inventory will be entered into the machinery for processing, and it will consider as a work in progress, and it will be converted into finished goods, and finished good will be stored in the warehouse for a period of time, and then it will sell to the customers. If it is credit sales, then the entity should wait until collect cash from customers. So all the total, the period between the purchase of material until purchase of material to cash received. So this period will be considered as an operating period, operating period. The operating cycle of an entity is the time between acquisition of assets, especially inventories assets, for processing, and their realization in cash or cash equivalent. When the entity's normal operating cycle is not clearly identifiable, it is assumed to be 12 months. So for some items may take more than 12 months to realize. For they are unable to sell within 12 months, within a year. For example, we can find this kind of items in slow moving stores. For example, slow moving stores we can find in some furniture shops and machinery shops, and wood shop and other things, right? So some inventories are unable to sell within 12 months. Some land in real estate also, some lands unable to sell within 12 months. So even though it is not realizable within 12 months, however, it is used for normal course of business, or it is falls under the operating cycle, then we no need to worry about the 12-month criteria. Then we can treat as a current assets. When the entity's normal operating cycle is not clearly identifiable, it is assumed to be 12 months. Current assets include assets such as inventories and trade receivables that are sold, right? That are sold mean what? Receivables. Consumed or realized as part of the normal operating cycle, even when they are not expected to be realized within 12 months after reporting period. As I explained earlier, some items are unable to realize within 12 months, but it falls under the operating cycle. Current assets also include assets held primarily for the purpose of trading. Purpose of trading. So buy and sell, not manufacturing. Just buy the inventories and keep the inventories and sell to the customers. Current assets also include assets held primarily for the purpose of trading. Example includes some financial assets classified as held for trading in accordance with LKS 39, especially for the financial assets 39, and current portion of non-current financial assets. Now we move to the current liabilities. Already talk about the current assets. Now we move to the current liabilities. An entity shall classify a liability as current liability. So it also has 4 criteria. It expect to settle the liability in its normal operating cycle. When we purchase inventories on credit basis, say 30 days or 6 months or 90 days or 180 days, so the entity purchase the inventories on credit basis, so they have to settle on due date. So it's coming under the normal operating cycle. It expects to settle the liability in its normal operating cycle. It holds the liability primarily for the purpose of trading, buy and sell. That time they become liable. They have to settle the money, so it's a liability. So the liability is due to be settled within 12 months after the reporting periods. Against short term, 12 months. The entity does not have an unconditional right to defer the settlement of the liability for at least 12 months after the reporting period. So most of the time, the entity does not have rights to postpone the settlement of liability. Normally, the entities do not have rights to postpone their settlement of the liability. In such cases, they have to classify the liabilities in their current liabilities. Sometimes entities may have rights to postpone the settlement of liability. So that is more than 12 months, then they can categorized under the long-term liabilities, because it is not a 12-month case, no. So therefore they have rights. An entity shall classify all other liabilities as non-current liabilities, as mean long-term liabilities. Again, there's a flow chart to decide whether a particular liability falls or categorized under the current liability or non-current liability. First criteria: the entity does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. So the entity does not have a right to postpone any dues settlements more than 12 months. So for example, I have to pay to my supplier. So 30 days I have to settle the amount within 30 days. I don't have any rights to postpone. Then it's come under the current liability. Some deferred taxes. if I don't have rights to postpone, then we have to go to the second step. I have, if I have rights to postpone, if I have right to postpone the settlement of the liability, then we can here. The liability is due to be settled within 12 months after the reporting period. Even though I have rights to postpone the settlement of the liability, but not more than 12 months. Again, it's fall under the current liabilities. I can't postpone. I can postpone for 1 month or 2 months, but I can't postpone with after 12 months, not exceeding 12 months. Then if the answer is yes, it goes to the current liability. Again, if the answer is no, the liability is due to be settled within 12 months after the reporting period, the answer is no, then it holds the liability primarily for the purpose of trading. So it's a normal course of business. Then it's coming under the current liability. If the answer is no, again, it goes to the final criteria. It expects to settle the liability in its normal operating cycle. If the answer is yes, it's a current liability. If the answer is no, then it's fall under the non-current liability. So these are the four criteria to categorize current liabilities and non-current liabilities. When it expects to settle the liability in its normal operating cycle, when it expect to settle the liability in normal operating cycle. Some current liabilities, such as trade payable and some accruals for employees and other operating costs, are part of the working capital and used in the entity's normal operating cycle. An entity classifies such operating items as current liabilities even if they are due to be settled more than 12 months after reporting period. So, as I already explained, an example for current assets, some assets are falls more than 12 months, inventories more than 12 months, but anyhow we include in the current liability, current assets. The same principle will apply here also. An entity classifies such operating items as current liabilities even if they are due to settle more than 12 months after the reporting period. The same normal operating cycle applies to the classification of an entity's assets and liabilities. When the entity's normal operating cycle is not clearly identifiable, it is assumed to be 12 months. And it should be assumed to be 12 months. When it holds the liability primarily for the purpose of trading. So earlier on we have discussed about operating cycle. Now we are uh, talking about trading. Other current liabilities are not settled as part of normal operating cycle, but are due for settlement within 12 months after the reporting period or held primarily for the purpose of trading. For example, examples are some financial liabilities classified as held for trading in accordance with LKS 39, bank overdraft, and current portion of non-current liabilities, non-current financial liabilities, dividend payable, income taxes, and other non-trade payable. So this also coming under current liabilities. When the liability is due, when the liability is due to be settled within 12 months after reporting period, or an entity classifies its financial liabilities as current and they are due to be settled within 12 months after the reporting period, right? Here, after the reporting period. If the original term was for a period of longer than 12 months, an arrangement, an agreement to refinance or reschedule payments on a long-term basis is completed after the reporting period and before the financial statements are authorized for issue. Right, there's some keys here. When and the entity does not have unconditional right to uh, defer settlement of liability for at least 12 months after reporting period. The entity does not have unconditional right to defer its settlement for at least 12 months after that date when it breaches the provision of long-term loan arrangements or before on or before the end of reporting period, with the effect that the liability becomes payable on demand. It classifies the liability as current even if the lender agreed after the reporting period. Right, very important here, after the reporting period and before authorization of finance statement for issue, not to demand the payment as consequence of breach. You know, the breach of contract, they are not honor, not perform the obligations in agreed manner. So, for example, earlier the entity has agreed to pay something, to pay a certain amount to a particular entity. They have agreed to settle within 12 months, right? With the agreed to 12 months, but the entity does not perform, did not did not honor the obligations, breach of contract, and however, after the reporting period, there's an agreement. Again, there's a negotiation between the entity and a particular entity, right? The supplier, for example. After the reporting period, they come to an agreement. Okay, uh, the entity justifies the reason for the breach of contract. So it's maybe due to the quality issue or COVID issue, pandemic issue, or economic crisis, or disaster, or some other uh, issues of within the company, sudden death or sudden blast within the organization. So there are some instances may happen. So in that circumstances, they may explain. So these due to these reasons, we are unable to honor our dues. And sometimes may the supplier or creditor may agrees. Okay, you may take 2 years more, 2 more years to settle. They have extended the date of settlement. In that case, right, later period they have agreed, but right, we have to pay attention, especially on what date the supplier or the creditor agrees to postpone the payment. So we have to check whether the agreement date is before or after the reporting period. If it is before the reporting period, it means that the company has time, the entity has time to settle the due more than 12 months, more than 12 months. But so right, the if the justification and the supplier extend the credit terms before the reporting period, say for example 31st December or 31st March, if it is happened before this reporting period, it may classify it under the non-current liability because they have more time to settle. But if they agrees after the reporting period, for example, the reporting period is 31st March, but the agreement occurs on May or June. So in that time, the entity does not classifies under non-current liabilities because the reporting period is past no. So we have to report as at on the reporting period, right? So here an entity does not have an unconditional right to defer or postpone its settlement for at least 12 months after the date when it breaches a provision of long-term loan arrangement on or before, right? On or before the end of reporting period with the effect that the liability becomes payable on demand. So on demand mean whenever the supplier or creditor demand the money, ask for money, they have to settle. It classifies the liability as current, right? No argument. Even if the lender agreed after the reporting period, after the reporting period and before the authorization of financial statement for issue, not to demand payment as consequence of breach. An entity classifies the liability as current because at the time of reporting period, the entity does not have an unconditional right to defer, postpone its settlement for at least 12 months after that date. However, an entity classifies the liability as non-current if the lender agrees by, right, by the end of the reporting period, by the means on the last day of the reporting period, to provide a period of grace ending at least 12 months after the reporting period, with, within which the entity can rectify the breach and during which the lender cannot demand immediate repayment. Thus, financial liabilities that provide financing on long-term basis, financial liabilities that provide financing on a long-term basis, that is are not part of working capital. It's very important. Not part of working capital and used in the entity's normal operating cycle. Not part of working capital as well as not falls under the operating cycle and are not due for settlement within 12 months of the reporting period are non-current liabilities, right? Non-current liabilities subject to the above bracket. So it's again we have a flow chart. So based on this flow chart, we can easily understand the previous slide. First, entity breaches a provision of long-term loan arrangements, unable to honor the agreement. Entity breaches a provision of long-term loan arrangement? No. If the answer is no, then it's non-current liability. Yes, if they breach the contract. Whether the long-term loan liability becomes payable on demand. Whenever they ask, they have to give the money. If the answer is no, it's a non-current liability. If the answer is yes, again they have to go this criteria. Did lender subsequently agree by the year end? By the year end means what? Or no before reporting period. Did lender subsequently agree by the year end not to demand payment due to the breach? Right? If the answer is yes, if the answer is yes, it means we have more time. The entity have more time to settle the money. So if the answer is yes, and it's become non-current liability. If the answer is no, did the lender agrees by the end of the reporting period to provide a period of grace ending at least 12 months after the reporting period, within which the entity can rectify the breach and during which the lender cannot demand immediate repayment. If the answer is yes, it will be go to the non-current liabilities. In other cases, it always come under the it's a current liability. So did lender subsequently agree and the year and but before the authorization of the finance statement for issue not to demand a payment due to the breach? If the answer is yes or no, the unconditional right to defer settlement of the liability for at least 12 months after the reporting period, then it's go to the current liabilities. In respect of loan, in respect of loans classified as current liabilities, if the following events occur between the end of reporting period and the date of financial statement are authorized for issue, that's some period gap, right? 2 months or 3 months, authorized for issue. Those events are disclosed as non-adjusting events in accordance with LKS 10, events after the balance sheet, events after the reporting period. So the refinancing on long-term basis, rectification of breach of long-term loan agreement arrangements, and the granting by the lender of period of grace to rectify a breach of long-term loan arrangements ending at least 12 months after the reporting period. So that's all about the current assets and current liabilities. Now we move to the into the income statement. That's the statement of comprehensive income. So up to now we have discussed about statement of comprehensive income. It's in simple term we call as income statement. Statement of comprehensive income. This is the name given by the LKS2, LKS1, and an entity shall present all items of income and expenses recognized in a period. So they can express, they can report the income and expenses in two ways. First, in a single statement of comprehensive income, in a single statement. So under the income statement, only one statement where you can find all income and all expenses. So the second statement, in single statement is one method. In two statements, it's a second method. Two statement means under the heading of income statement, you can find two separate statements, two separate income statement. One for normal course of business. That is first part. The second part is for other comprehensive income. Other comprehensive income, which means these are not part of normal course of business. So first one, a single statement, one statement of comprehensive income, or in two statement you can find two income statement. Statement displaying component of profit loss, you can find displaying component of profit loss, a separate income statement, and the second statement beginning starting with profit or loss and displaying component of other comprehensive income, statement of comprehensive income, right? There are two. First one is, this is you may find normally, you may find everywhere, single statement. Second method is you can find two statement. The first one is first part, the top part is displaying a normal business cost of income. Second part is here the other comprehensive income, right? So when you right, this is what single statement. This is single statement, right? Here you can find this revenue, cost of sales, gross profit, other income, distribution cost, admin expenses, other expenses, finance cost, share of profit of associate in case of group of company, profit before tax, income tax, profit before from continuous operation, loss from the continuous operation, right? Profit for the year. This is what Normally we prepare this kind of statement. In addition to that, you can find a title, other comprehensive income. Other comprehensive income. So these are the normal, not normal course of business. This one from revenue to profit before tax. Here, this is what we normally find as a, these are arises from normal course of business. But here, other comprehensive income. So item that will not be reclassified to profit loss account. So these items cannot be classified under any of these. So therefore, they put here other comprehensive income, right? Gain on property revaluation, investment in equity, remeasurement, revaluation, gain loss, share of gain or loss, property revaluation of associate, such things. Finally, you may get what? Total comprehensive income for the year. Total comprehensive income for the year. Right here, profit for the year and the minus other comprehensive income. This minus. So profit for the year plus other comprehensive income equal profit for the year. Comprehensive income for the year, right? So here profit for the year was 65, and other comprehensive income for the period is 28,000. So therefore, a total will be 93. Right? So this is one method. This is single statement. This is single statement mentioned here in a single statement of comprehensive income. Right? The second one is two statement, a statement displaying component of profit or loss, separate income statement, and second statement beginning, starting with profit or loss and displaying component of other comprehensive income. So I will show you the second part also. Here, this one, group statement of comprehensive income. Here, profit or loss for the year. Profit loss for the year. Here, this statement start from profit or loss, beginning with profit or loss for the year. You can find a symbol. So it's mean before this statement, there's another statement which calculate profit or loss for the year. And this statement here, other comprehensive income. So all the items are listed, are these are not belongs to the normal course of businesses, other comprehensive income, right? And finally you will get what? Other comprehensive income. So total comprehensive income equal other comprehensive income plus profit for the year, right? And here you may find total comprehensive income attributable to uh, shareholders here, holding company, controlling unit, and this is for minority interest, non-controlling interest. So this is the second type. So in simple terms, uh, two statement mean the first statement displaying up to this point, second statement displaying this point, but it start from this row, right? I think clear, right? The total comprehensive income equal profit loss for the period plus other comprehensive income. Profit loss for the period plus other comprehensive income, right? Here, the total comprehensive income equal what? This 8,484 comes from how? Profit loss for the period is 3,468. This is what? Normal course of business. And this part, 5,016, this is other comprehensive income. So therefore, it will equal to total comprehensive income. Same thing here, right? This is profit for the year, and comprehensive income and equal total comprehensive income for the year. Total comprehensive income is not the change in equity during a period resulting from transaction and other events, other than those changes in resulting from the transaction with owners in their capacity as owners. In simple terms, profit loss, it means it will directly impact on equity. If it is profit, it will increase the equity. If it is loss, it will reduce their profit. But this, so actually, the profit or loss will impact on equity. The changes in equity. The changes in equity is not come from the contribution of the shareholders, owners. So the contribution, the changes arises due to the business operations. Although this standard uses the term, right? There are some terms: other comprehensive income, profit loss, total comprehensive income. This one, profit loss, other comprehensive income, total comprehensive income. These are the term words. Although this standard uses the terms other comprehensive income, profit loss, or total comprehensive income, an entity may use other terms to describe the totals as long as the meaning is clear. For example, an entity may use the term net income to describe profit or loss. Profit or loss equal not net income. Right. Profit or loss for the period. Profit or loss for the period. An entity shall recognize all items of income and expenses in a period in profit or loss unless a standard requires or permits otherwise. Some Sri Lankan financial reporting standards specify circumstances when an entity recognizes particular items outside profit loss in the current year. For example, LKS 8 specifies two circumstances: the correction of error, rectification of error, the correction of error, and effect of changes in accounting policies. The SLFRS or CARE or permit components of other comprehensive income that meets the framework's definition of income or expense to be excluded from profit loss. Right. This is important, right? Other comprehensive income. Other comprehensive income comprises items of income and expenses, including reclassification adjustments that are not recognized in profit or loss as required or permitted by other SLFRs. The components of other comprehensive income include changes in revaluation surplus. Changes in revaluation surplus. So we will discuss in detail LK 16 property plant equipment. So we have a special chapter, standard alone chapter we have in this semester, right? In this subject. LKS 38 intangible assets. Second, accrual gains and loss on defined benefit plans recognized in accordance with paragraph 93A of LKS 19, employee benefits. Gain and loss arising from translating the financial statement of foreign operations. So LKS 21, we will discuss in separate unit. 21, the effect of changes in foreign exchange rates, and gain and loss on remeasuring available for sale financial assets. LKS 39, financial instruments. So these things will be, so these things are not arises due to normal course of business. So therefore, we unable to in classifies in the income statement. So we can show what admin expenses, selling and distribution expenses, and finance expenses. So these income and expenses are not part of normal course of business. Therefore, it will be disclosed in their under the other comprehensive income. The effective provision of gain and losses on hedging instrument in cash flow hedging. You see here under the other comprehensive income, you can find what items that may reclassified subsequently to profit loss. Currency translation differences. LKS 21. Currency transfer, foreign currency translation. Exchange gains, loss of translation of foreign operations reclassified to gain or loss on sale of business and fixed assets. Available for sale investments, cash flow hedge, market to market, mark to market, cash flow hedging reclassified to income statement, cash flow hedge reclassified to the balance sheet, so share of item relating to equity accounted entities, income tax relating to, yeah, it's very important, income tax, right? Income tax relating to items that may reclassified, and items that will not reclassified to profit loss, remeasurement, which mean what, revaluation of the net pension and other retirement benefits, liability or assets, share of items relating to equity accounted entities, income tax relating to items that will not be reclassified. So it's total other comprehensive income. It will be added to this value, total profit for the year. Then we will get total comprehensive income. So this comprehensive income will be distributed among two, controlling interest and minority interest. An entity shall disclose the amount of income tax relating to the each component of other comprehensive income, including reclassification adjustments, either in the statement of comprehensive income or in the notes. Here, income tax relating to item that may reclassified. Here mentioned, note number 7, right? Now 196. Again, income tax relating to items that will not be reclassified. This is what may be reclassified, here not be reclassified, that is this amount. Note number 7. An entity shall disclose the amount of income tax relating to each component of other comprehensive income, including reclassification adjustment, and either in the statement of comprehensive income or in the notes. An entity may represent component of other comprehensive income either net of related tax effect. They can show as a net value, net of related tax effects, or before related tax effect with one amount shown for the aggregate amount of income tax relating to those components. Reclassification adjustment. What do you mean by that? Classify again. Already classified under one line of item, and later reclassify under different line of items. So that is the adjustments. An entity shall disclose reclassification adjustments relating to components of other comprehensive income. Reclassification adjustments are the amounts reclassified to fit to profit or loss in the current profit that were recognized in other comprehensive income in the current or previous period. So information to be presented in the statement of comprehensive income. What information you can find? As a minimum, the statement of comprehensive income shall include line items that present the following amounts for the period. You may find revenue, finance cost, share of profit or loss of associate, joint ventures accounted for using equity method. You may study it under consolidated financial statement. Tax expenses, single amount comprising the total of post-tax profit or loss, discontinued operations. Discontinued operations. Some operations, some units are discontinued. The post-tax gain or loss recognized on the measurement to fair value less cost to sell, or the disposal of assets or disposal groups constituting discontinued operations. Profit or loss, you may find each component of other comprehensive income classified by the nature, share of other comprehensive income of associates, joint ventures accounted for using equity method. So it's replicated, no? Not replicated. It's a share of profit loss. This is what? Share of other comprehensive income and total comprehensive income. So you can find here. Right here, total comprehensive income. Right, this is equal what? Other comprehensive income for the period plus profit loss for the year. Profit loss for the year. Again, it should be very clearly disclosed. So profit attributable to owner of the parent and non-controlling interest, minority interest and the parent. Here, this 121. It's come from here. So this portion should be clearly disclosed. And also this part, put in this one. 107, this part. So separately they have to show profit for the period and total comprehensive income, this part. Based on their ownership of interest, they have to disclose owner of the parent and non-controlling interest. So there should be disclosed separately, profit attributable to profit and total comprehensive income. Right, this what? Here, the share of profit or loss loss of associates and joint ventures accounted for the using equity method, and share of other comprehensive income of associate joint ventures accounted for using equity methods. Items to be disclosed in the statement of comprehensive income. An entity shall disclose the following items in the statement of comprehensive income as allocation of the period. Here, profit loss for the period attributable to non-controlling interest, minority interest, owners of the parent. Total comprehensive. Here, total comprehensive income for the period attributable to non-controlling interest and owners of the parent. When items of income or expenses are material, an entity shall disclose their nature and amount separately. Circumstances that would give rise to the separate disclosure of items of income and expenses include write down of inventories to net realizable value, or the property, plant, and equipment to be recoverable amount, as well as reversal of such write downs. A restructuring of activities of an entity and reversal of any provisions of cost of restructuring in case of restructure, disposal of item of property, plant, equipment, disposal of investments, discontinued operations, litigation of settlements, and other reversals of provisions. And analysis of expenses we will discuss tomorrow. I hope all of you understand the things, and I will send you attendance link. Please mark. So